Hey, welcome back to Lunch at the Market. It's been a little while since we came to you in a video, but that's because we've been really busy. All right, so what's going on today? We're pretty much fully hedged out with the June 135, 131, 130 put butterfly. And I know it's a very lopsided butterfly. It would never fly in real life because one wing is $1 wide and the other wing is $4 wide. So what that gives us is basically, even if the market completely falls out of bed and goes all the way from 135 to anything below 130 on the SPY, which you just multiply by 10 to get that to the real market. So we're basically long protection at 1,350, and then our protection runs out at 1,310, which is it's a pretty good range. It's about it's a 40-point span of the S&P. If it goes anywhere below that, we get a full $3 for our spread. Okay, because we'll lose $1 on the short side of that spread. We're short from 131 to 130, and then we're long from 135 to 131. So ideally, it goes all the way through 130. Well, ideally, it goes to 131 and then stops there. But anything below that, we get a full $3 profit for that. We actually legged into it, so we were long the 130 puts, and then we got to sell our way into the rest of the trade, meaning on days like today, like many of the days last week, when the market just is gravitationally being pulled to the downside, we've sold what are basically we've bought ratio put spreads, meaning we bought for every 135 we sold 2 131s against it. And that's what ends up giving us our put butterfly, okay? Because obviously the short side, right, remember, gets shared by both strikes. So this is a long 135, 131 put spread, and then this is a short 131, 130 put spread, okay? We did that because it allows us to buy our 135 puts for free, okay? So we've got SPY, 135, 131, 130 put butterflies. We should be done with that today. We basically used every opportunity where the market looks terrible to leg into those, and we've actually gotten paid to put those on, so not a bad trade at all. Okay, second of all, normally when we see moves like down over 3%, names like Amazon, Salesforce.com, we like to sell spreads into that kind of situation, except we have really not seen the downside move that we normally see historically about this time. And so we're halfway through May. We plan on the rest of May and June really being a pretty ugly trading time. And so we'd rather just either A, take bearish bets, meaning long put spreads, or long put butterflies, rather than run the risk of selling a spread and then, like a Goldman Sachs, right? We sold the 150, 145s. Stock's at like 141 and change right now. So that's been a really ugly trade. The trade that we just ended up taking off. Initially, we had rolled out from the May 150, 145 to the July 150, 145. And then when the stock hit 139 intraday last week, we thought, you know what? When this thing came back up a little bit above 140, then we just took it off the table, walked away from the trade. Sometimes you just have to cut your losses, and this was certainly a trade in which we did that. We are rolling out our Molycorp May 62.5, 57.5 put spreads out to September to the 55.50. We get paid. We just had to increase the size by about 50%. We got paid a nice premium to do that, several $100s, and it gets us way down and out, way down and out. It's going to give us another 10% or so cushion. And that's you need a huge cushion for Molycorp because it is one wild ride. For all we know, the stock could be back up to $67 on Friday. But rather than risk all the time value getting sucked out and having to really have the spread go against us with not a lot of time in order to make a trade, we'd rather just increase the position just a little bit, roll it down and out to September, and get way down and out. Again, we're going to move the May 62.5, 57.5 put spreads down and out to September 55.50 put spreads. Every time we sold that 55.50 put spread, it's ended up worked out really well, really gone in our favor, and so we'd rather just stay that way. Look, with names like Bunge, BG, Total, TOT, Chevron, CVX, ConocoPhillips, COP, Banco Santander, Freeport-McMoran, Archer Daniels Midland, NLY, HIG, Hartford, Chubb, CLF, Cliffs Natural, all of these guys are trading at single-digit PEs. We continue to believe that for the long run, this market is really either A, attractively priced, or B, underpriced in a lot of areas. Look, even if we narrow it down to stocks with a single-digit PE, $1 billion in free cash flow, and over $4 a share in cash on the balance sheet, you still have ConocoPhillips, Freeport-McMoran, and Hartford. All of those look attractively priced, and we actually put on a Total 50-55 completely in the money long call spread today. We paid $3.20 for the January 2012. If as long as the stock doesn't decline by more than $2.46, then we get $5 for our spread that we paid $3.20 on. That's a gain of $1.80. Okay, it represents a better than 50% rate of return from now to January of 2012. That's really not too shabby. And instead of needing the stock to go up, so for instance, if you bought 100 shares of the stock, right? Let's equate that to a 5 lot of this in-the-money call spread. The in-the-money call spread is going to cost you $1,600. 100 shares of Total stock is going to cost you $5,746. If Total does absolutely nothing, in fact, if it just doesn't decline by more than $2.46, we're going to make over 50% rate of return, or about $900 on our investment on a 5 lot. 100 lot of the stock would need to go up by $9 a share in order to give the same gain, except you have $5,746 at risk just to make the same $900. And so it begs the question, why not use options instead of stocks? This is a great example of a really, what we like, low risk, high probability trade in which we use options instead of stocks to make really the same amount of money. Really, ideally, we're going to make more money because we've used less capital at risk. We don't need the stock to do anything except not decline by another 5% between here and January. And it's an oil stock with an unbelievable balance sheet, right? We just told you it's got a single-digit PE, billions in free cash flow, great amount of cash on the balance sheet. So check it out, January 2012. 50-55 in the money call spread on TOT. Should cost you about $3.20 to put on the trade. If you pay up a little bit from there, that's probably okay, but that's ideally where we try to catch the trade. Have some bearish bets. The last thing you want to do on a day like today, when the market goes down 40 after being up and then back up again and back down again, is to have nothing on your screen that's green. So try to be diversified. Actually, you should be diversified. Try to have some kind of hedges on, meaning make a bearish bet when all your other bets are bullish leaning. Have a great day, and we will see you tomorrow. Thanks for joining us on Lunch of the Market.